Good morning and welcome to the Prosper Group Limited's half-year FY23 results webinar for the period ending 31 December 2022. Presenting today is Prosper's co-founder and Chief Executive Officer, Greg Moshall. Co-founder and Chief Revenue Officer, Bo Bartoli, and Chief Financial Officer, Ross Adcock. Today's format will have the team run through the results presentation, followed by a Q&A session whereby investors can submit questions in the Q&A function at the bottom of the screen. I will now pass to Greg.
Thank you, Mel, and thank you for joining us for Prosper's half-year results ended 31 December 2022. My name is Greg Moshall, and I'm Prosper's CEO and co-founder. Please be aware that the presentation and supporting materials are now available on the ASX and our investor website on prosper.com. Throughout today's presentation, I'm pleased to showcase our new brand and purpose, which is to unleash the potential of every small business. This change indicates Prosper's evolution from being Australia and New Zealand's most trusted online lender to being a trusted financial partner of choice for small business. We're proud to work collaboratively alongside our partners and customers to make business happen. I will begin today by running through our performance for the first half of FY23. Over the half, Prosper continued to observe an ever-increasing demand for commercial credit across all distribution channels in Australia and New Zealand. As a result, we achieved strong originations of $425 million, up 35% on PCP, our highest half-year performance on record. Driven by powerful origination momentum, we finished with revenue of $135 million. This was up 72% on PCP, and closing gross loans reached a high of $856 million, a 66% increase on first half 22. Operating cash flow closed at $47 million, representing a 98% increase from first half 22. Our cash position was supplemented by the term deal completed during the tail end of the half, tight management of operating expenses and capital usage. Despite the significant growth in originations, we held our portfolio yield at 34.8% for the half, demonstrating our products have great cut-through with our customers. EBITDA has been impacted by $29.6 million increase in loan provisioning during the half, coming in at a positive $200,000 for the period. Turning to slide 5. Recognised as Australia and New Zealand's most trusted small business in our category, we have funded more than $3.2 billion to over 47,000 small businesses since our inception in 2012. Success comes from our customer-centric ethos, with investments made to further enhance our customer experience, driven by increased automation, serving approximately 19,900 active customers. We are proud to maintain our market-leading Net Promoter Score, which further demonstrates our commitment to providing our customers with simple, seamless, and stress-free financial management tools. In response to evolving macroeconomic headwinds, the business continues to take proactive measures to strengthen business models through the application of dynamic risk and commercial settings on our loan book. Alongside prudent risk management, we have continued to support the consistent demand for credit by small business, resulting in Prosper's highest half-yearly originations to date. Our ever-growing business has continued to sustain a strong balance sheet with no corporate debt and a solid funding platform of $1 billion in secured funding facilities, of which $208 million is undrawn, $125 million in cash, and $38.9 million of that being unrestricted. Our cash position has strengthened by our second public asset-backed securitization of $200 million, completed in December 2022. This was another fine achievement during a time where we saw capital markets tighten. Prosper's proven approach in supporting small businesses requiring capital during challenging economic times, coupled with our tightly managed financial position, enabled us to remain focused on continued investment to scale existing products and to launch and expand needs-based solutions for our customers. This broadens our appeal and further expands our growing customer base as we expand our suites of financial management solutions through our diversified distribution channels. Overall, sentiment across the small business sector in Australia, according to a study carried out by YouGov in Jan 2023, found that 69% of Australian business owners rate the overall health of their business as good in the current environment. with 28% expecting to access external funds over the next 12 months. We will continue to monitor the emerging macroeconomic headwinds, as 84% of Australian businesses owners anticipate challenges for their business over the next 12 months. This is where our decade-old proven credit decision engine outcomes and dynamic portfolio risk and commercial setting capabilities will endure. Prosper anticipates continued growth within the credit market for small businesses and is well positioned to grow its market share within the $24 billion market opportunity. I'll now hand over to Bo Bertoli, Chief Revenue Officer and co-founder, who will take you through some first half highlights. Ross Orchard, Chief Financial Officer, will then take you through our first half financial performance. And after that, I'll provide an update on our strategy and outlook before taking any questions.
Thanks, Greg. Turning now to slide 9. Prosper was well positioned for the resurgence in small business credit demand, which drove significant uplift in originations for our small business loans and our business line of credit products across Australia and New Zealand. Our flagship products continue to be further enhanced with improved efficiencies, including more automation, quick quotes for our partners, and faster approvals for our customers. Improvements to our digital cash flow management tools, which include the Prosper app, Prosper Partner Portal, and Prosper Online, also continue to enrich our customers' digital experience. And these enhancements have been well received by our customers and partners, as evidenced through our higher engagement statistics, with average logins per user increasing by 28% from August to January, and daily active users increasing by 27%. This demonstrates that we have become a more integral part of our customers' business, and we expect that this will increase our active customer lifespans. Our first half results saw origination growth across all channels, with the small business loan product up 33% on PCP to $323 million, and Prosper Business Line of Credit up 41% on PCP to $102 million. Our New Zealand originations for the first half were up 85% on PCP to $93 million. And we have seen steady uptake of the business line of credit product since its launch in New Zealand in July 2022. Again, this demonstrates the value and appeal of this product in the New Zealand market. By providing our customers with easy access to credit, we are empowering them to invest in their business and achieve their goals, which strengthens our business as well. Turning to slide 10, our strong growth in originations made a considerable contribution across key growth metrics. Our closing gross loans increased by 66% on PCP, achieving a record high of $856 million. Revenue for the first half of $135 million was also achieved, and this was up 72% against PCP. We are encouraged by this result, and our approach to active yield management has ensured strong cash revenue generation from our core products, and we will continue to take a disciplined approach in this important area. The results over the period have continued to increase our operating cash flow, which was up by 98% on PCP to $47 million. Our prudent approach to cost management has helped our employee and operating expenses reduce by 11 percentage points on PCP in proportion to our revenue. These results reflect our capability to scale our lending products while efficiently managing costs at sustainable levels. Origination and growth and book growth, combined with active yield management, has delivered a strong top-line performance this period. And as the year progresses, we expect to see continued customer demand from our diverse portfolio of small businesses. On slide 11, we'll cover some of our credit risk performance. Prosper continues to dynamically manage approvals within our risk appetite. While arrears have increased, we have proactively tightened risk settings in the half, including loan value caps and increasing our cutoff score for approvals. We continue to monitor these adjustments and are prepared to take further changes to ensure that our risk outcomes from our portfolio are sustainable and within target. In response to the evolving economic headwinds, expected loss provisioning increased to 9.4%, including increasing our macroeconomic overlay buffer from 1.3% to 2.4%, and a modelled provision of 7%. We believe that the additional provision is prudent given the current economic environment. Moving on to our portfolio, our well-diversified portfolio is a key part of our risk management strategy, with the flexibility to specifically target sectors and geographies based on market conditions and customer needs. This is aided by our credit decision engine, which allows real-time dynamic risk profiling and decisions, and allows us to direct our products to an assortment of industries and businesses. 45% of our customers are also existing customers, and we undertake a full credit application on each renewal customer, overlaying their repayment history with us to any changes in their business operations. This helps us to further manage our risk outcomes. As noted, we will continue to carefully monitor our portfolio mix to ensure that our new and repeat originations across 2023 deliver risk outcomes within our appetite. I'll now hand it over to Ross to talk through our first half financials.
Thanks, Bo. As Greg and Bo have noted, it's been a period of significant top-line growth. The record result for originations has set us up well for the full year. Most importantly, we were also able to optimize our cost base, despite undertaking investments in our products and technology during the period. These strategic investments have improved our customer lifecycle management and strengthened our data and insights capability. This will support better decision-making and enable long-term growth. In addition, our operating cash flow of over $47 million, up 98% on PCP, demonstrates our ability to generate cash for growth. EBITDA of $200,000 compared to $9.6 million in PCP has been impacted by the $29.6 million increase in credit provisioning. Despite the significant growth in originations, we held our portfolio yield at 34.8%, demonstrating our products have great cut-through with our customers. Funding costs increased in the half as a result of cash rate increases in Australia and New Zealand. Prosper has been successful in minimising the impact of these increases due to efficiencies in our funding structures that were undertaken last year and through our access to the term asset-backed securitisation market. In the past 6 months, employee and operating expenses as a proportion of revenue have dropped from 47% to 37%. Investing in our product and technology teams while maintaining our cost base demonstrates our ability to deliver growth and value on a scalable cost base. Our focus will continue to be on managing our operating efficiency and optimal resource planning as potential cost pressures emerge in the economy. Total loan impairment expense for the half was $56.6 million. The expected credit loss provisioning is $29.6 million, of which $10.7 million relates to asset growth. The remainder relates to the increase in the provision rate, as Bo referenced earlier. Net bad debt expense as a percentage of our average gross loans increased to 6.9% compared to 6.6% over the same period last year. This can be attributed to a slight uptick in non-performing loans. During the half, we proactively revised our commercial credit risk assessment policies in line with changing conditions, ensuring we balance risk and customer needs to maintain a sustainable portfolio. Our growth has helped sustain a robust balance sheet with no corporate debt and a solid funding platform with over $1 billion in external funding facilities, of which $208 million is undrawn, setting us up well for future growth in originations. In addition to these external funding facilities, we launched our second term asset-backed securitization, a $200 million transaction in December 2022. Despite challenging market conditions, the transaction was well supported. Prosper has a healthy balance sheet with the ability to generate sufficient cash that enables us to invest in our growth and technology plans. Now I'd like to hand back to Greg to update us on the company strategy and outlook before we provide an opportunity for you to ask questions.
Thanks, Ross. Our vision is to serve more small businesses with our innovative digital products to enable our customers to seamlessly grow, run, and pay. In late 2021, we shared our strategic roadmap that makes this vision a reality. We're now 2 years into this and have made noteworthy progress with new products, including our all-in-one business account and overdraft, which are now in market. We started by building upon existing lending products to address the ongoing need for capital in both Australia and New Zealand, which remains the key to the vitality of small business. We believe that the capital needs we are solving for are critical to keep small businesses moving, even more so now as macroeconomic impacts are being felt and as traditional lenders tighten up their credit risk appetite. Our innovative Prosper business account has evolved over the past 12 months, with new enhancements added after our pilot phase. Prosper's business account is the first step beyond lending into solving a broader set of cash flow management pain points for small business. Our new brand, alongside our business account, signifies a new era in small business financial management services. Prosper's expanded product offering transforms the company from the #1 online small business lender to the financial services partner of choice for small business. By addressing a range of cash flow management challenges experienced by small businesses, our strong value proposition will help us accelerate Prosper's customer base, win a greater share of wallets, and increase customer lifetime value. As we capture additional market share, we foresee significant opportunities to cross-sell our products and diversify revenue sources for further growth. Over the past decade, Prosper has revolutionized small business finance. We understand the unique challenges facing small businesses and are delivering solutions that address their pain points. Our capital products are pioneering, and the introduction of what will become the country's first all-in-one financial management business account that will provide a cohesive platform, making Prosper indispensable to small business. With the business account, customers can manage their cash flow all in one place via a free, easy-to-use account with no minimum balance or deposits needed. The product also includes a Visa Business Debit Card, Apple Pay, and Google Pay. Customers can take advantage of their new instant payment methods at home or overseas, pay bills via BPay, or schedule payments in advance. The business account continues to achieve steady month-on-month growth as we continue to reach new customers. Leveraging insights honed over the past decade, we will deliver a digital financial management tool that is frictionless and personalized for every small business customer. Over the calendar year, we will start introducing fresh solutions to complete our integrated suite of cash flow management products. The suite of tools includes an overdraft facility, currently in pilot phase, integrated access to our existing loan and line of credit products. Prosper remains well positioned to support the rise in demand due to investments made to scale existing products to deliver innovative solutions to address the needs of small business. Prosper is well positioned to continue to grow our market share within the $24 billion credit product market across Australia and New Zealand. Our growth strategy outlines an exciting and significant phase of transformation for Prosper, an opportunity to extend our capabilities to support a vast array of small business. With the complementary suite of Prosper's products, there'll be more opportunities to cross-sell, drive down cost to serve, diversify revenue, and invest in further growth. Our vision for Prosper's future state is providing a cohesive platform that makes Prosper digitally indispensable. By bringing together payments, cash flow, insights, and credit solutions, we help small businesses grow, run, and pay. Prosper's payment solutions enable customers to manage daily expenses, bills, and their accounts payable. Our credit solutions fund growth opportunities, and smart-driven insights enable better decision-making, and real-time data enables Prosper and our customers to overcome challenges and opportunities. By integrating these into a seamless financial management platform, Prosper enables small business with the tools to manage their cash flow effectively. Our first half 23 results today are testament to our team's commitment and capability to deliver value for our partners and customers. I'm confident we will continue to be a company that thrives, and I look forward to sharing with you the progress throughout the fiscal year. I would now like to bring our formal remarks to a close, and I'll open up to any questions.
Thanks, Greg. A reminder to all investors that you can pose questions in the Q&A box at the bottom of the screen. So our first question is, understandably, Prosper is preserving capital for technology investment and growth. Is there a point where the company needs to get to before you would consider distributing dividends, given the reference to the business being highly cash generative on the 13th of Feb business update?
Thanks very much, Mel. I can answer that question. Look, each year we look at our capital position, and we evaluate how best we allocate it. And over the although we obviously believe that we've seen significant growth in our loan book, and as a result of that, we believe that it's best placed to allocate our capital there. Although we do understand, obviously, that we've seen quite good growth in our cash balance, but we obviously continue to reevaluate that at all times.
Thanks, Ross. Our next question is, are you seeing growth in the book since 31 December at a rate similar to that has been reported?
Yeah, I'm happy to take some comments on that. So we certainly are seeing continued demand across the Australian and New Zealand economies, and we do feel like it's coming from a couple of places. So Greg spoke to some of the data on just small business sentiment, how many of them are feeling that their business is in a good place, but that there are some challenges ahead. So we're definitely seeing customers who are preparing and getting their balance sheets into the right positions. We also are starting to see from the appetite of the large banks, they're starting to move more and more away from the small business economy. There are definitely pockets of opportunity that we are seeing starting to emerge in that sector. And all in all, we're seeing a continued, rise in that demand. The one thing I just caveat to all that is that we are also taking a prudent approach to how we take risk in this environment. Although a lot of the economic data is still relatively strong, for example, unemployment is still at very low rates, business failure rates are still quite low. We still feel that there's a real prudent approach to take here in terms of that risk that we are taking on. So whilst we are seeing a lot of business, we are going to be selective about the business that we write. So it's hard to forecast exactly what our growth trajectory will look like this year. As I said, we'll certainly take a very hard look at a lot of businesses, but we'll be more selective in the business that we choose to write. And again, we think that that's just the right approach to take in a little bit more of an uncertain economic environment. And particularly while the RBA and the RBNZ are continuing to rise interest rates, it's very important that we keep a close watch on the risk appetite that we take. Having said that, our existing customers, as we mentioned, represent over 45 to 50%, depending on the month, of our customer flow. We know our existing customers very well, and we have additional data points on those customers, including their repayment history and other data sets with us. So we will continue to work very closely with our existing customers. We believe there's still a lot of growth to be had from our existing base as well. So we will have a lot of choice around where we take our growth from in the year ahead.
Thanks, Bo. We've got a couple more questions on the loan book. Are there any particular industries that you're seeing more demand for additional funding? And is there some stress in these same industries from existing customers?
Yeah, so overall, we have talked about increasing our provision. We did see some upticks in certain segments within our customer base. That is more broadly linked to the lower grades that we lend into, not specifically a definitive industry mix. We are still seeing a broad range of industries that are coming to us, and we don't believe that demand is stress-based. Our demand is generally used for funds that are actually for positive uses, and our customers are actually looking to grow within their business. Absolutely, we'll continue to monitor that. We do look both at concentration risk across industries. So we try not to have too much concentration in any one place. And then we have been certain areas that, for instance, parts of potentially building and trade and those industries where we have mentioned that we have taken some stronger risk setting reductions on. But overall, we feel the portfolio still has a good mix and a healthy risk, with no industries being greater than 30% of our portfolio.
Thanks, Greg. And just on from that, what's the largest loan size to any single customer?
So our loan sizes do go up to $500,000. However, our average loan size is closer to $40,000. So although that is the amount that we go up to, our averages sit more at that small business end, and the average, as I said, is around 40,000. Thanks.
A lot of money is being spent on technology. Is there a roadmap which brings that level of spending down soon?
Yeah. I might actually take that one as well, Russ, and you can add to it. Essentially, we are a company that absolutely believes that technology is a differentiator for us, and we have been since we started. It gives us value both from an experiential point of view, giving customers a seamless and frictionless experience. It's allowed us to build into new products and solutions like our all-in-one business account, as well as it's been the key component in building out our credit decisioning capabilities, both from a data and ability to decision in an automated and seamless manner. There has, however, been a very large exercise that we are moving towards the later stages of, which has been essentially a replatforming exercise. That is a very large cost. You will see that coming through in increased CapEx. Absolutely, that is an amount that we see over time. We will be able to look to reduce through those projects coming off. So we do still see ourselves investing in technology and having technology as an investment, but we absolutely do see opportunity post the finalization of our replatform to either bank those extra costs, or if a business case is there, to reinvest. But we do think there will be opportunity there.
Thanks, Greg. And with the increased loan provision, do you expect the static loss rates to exceed the board mandated risk appetite of 4 to 6%?
Look, in the short term, obviously, we've seen arrears tick up. There may be a situation where it gets at the higher level towards that 6%, and we may see some cohorts exceed that. But the risk decisions that we've proactively been undertaking, we believe will mean that we remain within those levels on the longer term.
Thanks, Ross. And just a question on yield to finish up on. Should we expect our yield to increase as the interest rate environment changes?
I'm happy to take some comments on that, or make some comments rather on that. In terms of the yield environment, as Ross quite rightly pointed out, we've been, I guess, a beneficiary of some capital cost reductions and optimization as we've worked through the ABS markets. So we haven't had as much pressure on our top line yields as perhaps some other lending products out there out in the market. One of the things that we're always conscious of is balancing the right mix of pricing to customer outcomes. We were proactive in terms of looking at our yield management. We have been steadily increasing in certain pockets and certain products. And we take a consistent ongoing basis, or on an ongoing basis, we'll look at this. For us, really, it's the net interest margin that's really important. And again, pleasingly, that was steady for the period for us. So it's an area that we consistently measure and monitor. If we need to continue making adjustments based on movements by the RBA and RBNZ, and then the capital markets, we are prepared to do so. What's again pleasing is we've been able to expand our yield, demonstrate that there is more capacity for pricing increases, I guess, out there in the market. But again, it's something that we do with careful consideration. Once again, our product is not as sensitive as some other lending products in market, for example, a mortgage. And we do have a lot more flexibility with pricing. So we're constantly monitoring it. We're going to continue to evaluate if we need to make changes. And if we do, we will be prepared to make those.
Thanks, Bo. That was our final question. So I'll pass back to you for final comments.
Thank you. Just appreciate all your time and support as an investor group, or for those of you that are looking at Prosper to better understand the company. Once again, we're proud to present our results, and we look forward to the future of the company.